Week that was, Phil, welcome. We've seen crude oil holding at stubbornly elevated levels, price at the pump at record levels. Can you talk to us a little bit about what we've seen in terms of central bankers and their efforts to combat inflation? Most recently, the BOJ, a very accommodative stance continued. We heard from Kuroda overnight.
Yeah, surprising that they were so accommodative. I mean, I think they're taking a slightly different approach. What they're doing is they're looking at what will the impact of raising rates do for their economy? What is it doing for the U.S. economy? You know, raising rates doesn't necessarily, and you're raising borrowing costs, doesn't bring down the price of something like soybeans.
Right, or crude oil. Right.
Crude oil, for instance, right? So, you know, they're trying to, you know, hit the mule with the 2x4 right in the head and just kind of dumb everything out there and kill inflation across the board. Will that strategy work? It's a little too early to tell. So I think you got to pump more crude oil. You got to have ideal growing conditions. You've got to have supply chain issues resolved. You know, for every job that's out there, there's actually 2 jobs for every person looking for a job. So, you know, you've got to fulfill those pockets and those needs. Then inflation comes down naturally. By raising borrowing costs aggressively, you know, I don't know if that's the solution.
Yeah, you know, Phil, I think you bring up a good point there, because in terms of the efforts that the Fed is attempting here, and we can get a little bit more into it in a second, but versus the BOJ, for one, we've seen the discrepancies in terms of the currencies, the strength in the U.S. dollar versus the weakness in the Japanese yen. If we could pull up the yen here, because we actually just posted a new low, a new multi-decade low in the overnight session. But Phil, in terms of that point here, this is actually the corn contract. If we could pull up the yen. But actually, to that point here, Phil, I just wanted to kind of get a little bit more into that, because you mentioned kind of whacking the mule on the head with this 2x4, and there's concerns about here what the Fed's doing right now in terms of this initiative, because it is a bit more of a commodities kind of driven situation. They're talking about impacting demand, but one could argue what we really need to see is some investment here in the energy sector. We're talking whether it be through technology to improve efficiency, or just ultimately in new wells and pipelines, or, you know, the transportation thereof. So infrastructure, I mean, ultimately, I guess we're talking about, but increasing production, basically, one way or the other.
The increase in production, the problem is that obviously, you know, the political party at hand, they've got this green initiative. They don't want to see that. People are a bit too worried that if they start putting CapEx spending, will regulatory changes impact it over the long run? So, you know, are you throwing good money after bad?
Right. And in the past, these investments haven't really fared so well for them for the most part.
Yeah, so they've got to slow this down. I mean, a lot of it, too, is that, you know, there's like, so yesterday I flew into Chicago, and there was a family that's flight was canceled, and they elected rather to, you know, drive than fly. You've got to work out some of these issues here. You need to get airlines back, get those jet fuel costs down. And you start resolving that, then everything naturally comes down. I think that that inflation across the board, it's going to resolve itself. We will see disinflation over the next few quarters, and that borrowing cost will impact the consumer. You know, now your mortgage payment just got a lot higher, especially if you're going to try and, you know, buy a new house right now, or rents. Rents are at all-time highs at the moment. So there's a lot of issues that are out there that will cause this deflationary effort going forward.
So, Phil, you sounded initially a little bit skeptical in terms of the Fed's aggressive stance this week, and at least in terms of achieving their goals, but it does sound like you feel like inflation over the shorter to mid-term here is going to kind of correct itself. Not necessarily it's the Fed's kind of pulling the levers of, but just sort of the run-up in price creating its own demand destruction.
Well, the Fed is making a major policy mistake. You cannot raise rates into an economic slowdown and raise rates aggressively. You just can't do it. They were supposed to do it last November. They got scared because of the new, you know, virus. They didn't want to kill the market momentum we have. So what's happening is they're looking in the rearview mirror. They need to be looking forward. They need to see that disinflation will come. They need to see that a recession will come. We've paved the path for it. And, well, you know, they need to back off.
That being said, then, I mean, I guess the thought is maybe rates would back off a little bit here, because they've potentially overshot at this point to if we do follow that trajectory that you're kind of suggesting.
Yeah, 100% precisely. That's why you're seeing that small recovery in bonds and also in the 10-year, because it's going to factor in. They won't grind out. And he even said that, like, 75 basis points is not going to be like this reoccurring theme. So they got to take it one step at a time. They'll probably see inflation flatten out. They'll go with 50 basis points, and then they'll go from there. So, I think go ahead.
No, well, you go ahead. I want to finish your thought, and then I just wanted
to say, and then other central banks are taking these, they feel like they're getting behind the curve. So that's why you see in the Swiss National Bank make such an aggressive policy action. I think Bank of England was a little bit too accommodative, only going 25 basis points, but they never do 50 basis points.
Yeah.
So, but these are, different times. You got to step outside the box.
Australia, for example, I mean, they've got wage inflation there. I mean, they just ran up their minimum wage here. They've seen very strong job growth. So it does seem to be kind of this Western world trend that we've seen, again, compared to the Bank of Japan and PBOC. Talk to me a little bit about, when you talk about things slowing a little bit, are you looking at some of the indicators that we've seen? I mean, the Michigan sentiment data last week, for example, I mean, at a record low. We've seen housing come off significantly. The new home sales, even the data this week at NAHB, I think it was the building permits, housing starts yesterday. I mean, what are you looking at in terms of suggesting that we are seeing that slowdown?
Small business sentiment, that's at record lows. You had that Michigan sentiment, consumer spending, savings.
Yeah.
These are all at record lows. And then the credit that people are using to finance,
it's running up.
That's running up.
Yeah.
So this is all setting up for a disaster. And when you have that credit at record highs, you got the savings at record lows, you increase the borrowing costs. Man, that's really going to put the consumer in a bad position. So that's why there's a lot of things out there that are setting up this recession to come to fruition.
Phil, talk to us a little bit about next week in terms of some focal points here as far as this discussion and what to watch for as the dust settles from a busy week as far as central bank activity.
Every single day, it looks like there's central bankers talking and key central bankers. So, you're going to want to
I saw Waller over the weekend even.
Yeah, if they're going to backpedal it all, maybe try and spin this a bit dovish, see if they can acknowledge the damage that's been done to U.S. equity markets. We do have CPI next week. That'll probably have another big print. So there's a lot of economic indicators, but it's the central bankers. It's going to be, as soon as you see a knee-jerk reaction in the market, that's the first thing you're going to want to look for is what did a central banker just say? Then
my next question would be, if they come off a little bit more dovish and we get a little bit of a rally, continued a rally in terms of what we're seeing, if this holds here today into the weekend, do you think that would be met with more selling as, again, kind of that longer-term sort of recovery discussion could play out for a while, inflation maybe peaking but plateauing ultimately? I mean, what does this mean for corporates, ultimately the indices, as we do potentially see rates come off and the Fed have to kind of take their foot off that aggressive stance on the brake pedal?
Any significant rally, if you feel like you're overweighted, you need to lighten up on it. Don't be a hero. Don't chase the market.
You've been saying that for a while.
Yeah, bear market rallies are vicious, and I think that we continue to press lower as we're going on.
Okay. Phil, lastly, your thoughts on Bitcoin here is one of the products that people were watching this week, a reflection of investors' concerns, unease, and their unwillingness to, hold on to these riskier assets. I had been kind of harping on recent comments from Christine Lagarde, who had basically said that, it was worth nothing a couple weeks ago. But even this week, Bill Gates had some comments where he essentially said the same thing.
Yeah, I'm not a believer in Bitcoin. I actually hate Bitcoin. I think that it's nothing more than a high leveraged, NASDAQ type place. So it works in a high growth environment. That's not where we're at. I don't think it's going to zero. The criminal enterprises will keep it worth something. So, but I do think it could get halved from here. And then maybe it'd be a value play to put in there for a long time. But who really knows? I'd rather own gold. I'd rather own silver. And that's it.